And we are live. Hello, everyone, and welcome to the 2021 Colorado Economic Summit. We are glad you're joining us. We are coming to you live today from the Infinity Park Event Center in Denver, Colorado. My name is Lane Lyon. I grew up right here in the area in Aurora, Colorado, spent many years on the news telling the stories in Denver, Colorado, but in 2012 I ventured over to real estate and am excited to be your host this afternoon with a lot of great information. And I have to say, we are honored that you are joining us as well. You know, we are here in the Infinity Park Event Center. It's a little lonely, but I know all of you are out there. Certainly, we've gotten a little bit more accustomed to this. And for the last 11 or 12 years, many of you have attended at the PPA Center, just north of Bronco Stadium. So it's a little different this year. We're getting used to that to some degree, but nonetheless, we have a lot of great information and very compelling speakers coming your way. We have a great lineup, as I mentioned, of local and nationally acclaimed presenters to give you an update as it pertains to the residential real estate market, the rental market, I should say, the residential real estate market, what's happening in the Denver metro area, and heck, we'll just go broader from that, regional and nationally as well. Want to show you the screen right here. These are our sponsors. We want to give you a second to look at them real quick because certainly we appreciate their help in bringing the Economic Summit to you this afternoon. Without further ado, let's get started with our program. We're going to begin with Greg Batchelor. He is the owner of Real Property Management Colorado, one of Colorado's premier residential property management companies with offices in Denver, in Colorado Springs, and Northern Colorado. He and his team of about 30 employees oversee the day-to-day management of more than 1,300 properties with corresponding clients, residents, and vendors. Greg joins us today to update us on what's been happening in the rental market along the Front Range and the impacts of COVID-19. So please, let's have some applause from our studio audience and have you at home hear Greg Batchelor. Welcome.
Thank you, Lane. It's great to be here today. Thank you so much. It's great to be with all of you. And as Lane acknowledged, it is a little bit different today. We're a bit used to having you all here in person, but it's great to know that you're all here virtually. We're going to have some fun. Today I get the opportunity to chat a bit about what's cooking in the Denver area and broader on the Front Range rental market. And there is lots going on. One of the things we're going to take a minute to just stop for a second is think back, how much did COVID really have an impact on the rental market? As you might recall, as we look back to March and April of last year, the themes were, in general, the sky is falling. The rental housing crisis is underway. Evictions are going to be out of control. Renters won't be able to pay rent. Renters are demanding free rent. If you recall, there were people marching in the streets for free rent movement. The vacancies are going to pummel the real estate industry, specifically the rental part of it. Everyone was wondering, all of us included, those of us that were in the residential property management space, we were wondering, will those things happen? And then the themes began to change and the themes began to emerge a bit. By the time we got to the summer and the fall, well, the rental housing crisis clearly hadn't emerged at that point in the ballgame. Landlord foreclosures, though, were predicted to mount. Landlords and tenants began figuring that we could work things out, that we didn't necessarily need courts open. We didn't necessarily need evictions to be able to handle things, that we could work out payment arrangements. There was a number of different things. And so the themes began to scale back just a bit. Less involvement, quite honestly, was needed from the courts. Then by the time we got to November and December, all of a sudden we stopped and we went, wow, most renters have been able to pay their rent. There's not a rental housing crisis at this point. Evictions have been very minimal. Landlords and tenants are still working well together in most cases. We still don't need the courts to get involved. We saw a lot of that. And interestingly enough, vacancy rates remained incredibly low. There were a number of eviction moratoriums at the federal, state, local levels. They really haven't been problematic. So it was fascinating to watch so much doom and gloom that was predicted out of the onset to get to the end of the year and realize it really didn't play out. So what are some of the early 2021 headlines that we're now seeing? Well, Rent collection rates were stable in December. They're 94%. That's just not that much different from what rent rates and collection rates were pre-COVID. We click into January, the first month of the year, and as of the 20th, they're 93.5%. That's very normal. If someone didn't tell us that we're in a pandemic, those stats would not in any way, shape, or form give us reason for alarm. The apartment market has really held its ground. It's had some tough spots along the way, and interestingly enough, single family home rental rates continue to climb in a pandemic. Let's talk apartments. We'll switch gears just for a moment. We'll talk just specifically to this one segment. Up and down the Front Range, builders added roughly 11,000 apartment units, primarily in the Denver metro area, but some in the Colorado Springs area, some up in northern Colorado. About 8,000 of those were rented out, which leaves some excess supply, but a number of those are still coming on. They're getting leased right now. Many of those units, anybody walking by, and we've been saying this for the past couple of years, you can't help but drive by downtown Denver without seeing cranes. And what sits below a lot of those cranes is an apartment complex. And a lot of them were really, really high end, and their rates continue to increase all the way through this pandemic. The only apartment buildings that we really saw struggle here in the Denver metro area, anything that was built 2010 or later, those rents actually went down. They didn't have the amenities to compete. They did not have the affinity pools. They did not have the rooftop pools. They don't have dog washing stations. They don't have wine fridges built in place of a cabinet. Those kinds of things we began to see playing out. Single family rentals, this is absolutely amazing. All of these data points here were up 3 to 7% year over year, 2019 into 2020. Every single county, we saw growth, average bedrooms 1 through 6, growth, and then in every single one of the segments, multifamily condos, townhomes, and single family homes, we saw growth in each one of those areas, minus that one segment of older condos and older apartments in the downtown area. Those struggled. There was just too much competing inventory on that. This is a fascinating statistic, and we've looked at this, and we've brought this to you a number of times. U-Haul puts out research every single year on where are people moving from and to, and they do it on a by-state basis. So in 2016, Colorado ranked 11th in terms of the number of people that were using U-Hauls one way into Colorado. 2017, we were 9th, and then all of a sudden, the rental market began to get more expensive. 2018, 16th, last year, 2019, we were 42nd of the 50 states of people moving here. And when I sat here and addressed, or when I stood here and addressed this economic forum last year, one of the things that we looked at specifically was how expensive the Front Range was getting. And so fewer and fewer people were moving here because the Front Range got so expensive. And then all of a sudden 2020 happened. And now we're the 6th largest area of the six states, largest moves coming into Colorado. That's a fascinating turn to go from almost at the bottom to almost in the top in 1 year. And one of the things that we have seen with that is there's a number of regional markets around Colorado who we have a sense that their economies just aren't picking up as fast as the Front Range economy is picking up. We are watching a lot of people move from Des Moines, Iowa, from Omaha, Nebraska, and Tulsa, Oklahoma, and Boise. We're watching people move from Salt Lake City, and we're watching people move from Albuquerque. A lot of these tier 2 regional markets that sit around the Denver area, I think jobs are picking up much faster here in Denver than they are elsewhere, and so that naturally gravitates people to Colorado. And make no mistakes about it, renters still want to live here. For the second year in a row, Denver is the #1 rank for inbound renters looking for a place. 48%. I was the most researched city at 48%. That's 2 years in a row. People want to live here, and we get that. Those of us that live up and down the Front Range, we live here for a reason. It's quality of life. It's the beauty of our Rocky Mountains. You name it, the list goes on. It's a beautiful place to live. People want to be here. Some of the highest apartment rents, and we continue to be stunned by this every single year. Last year, we saw the highest apartment rents exceed $15,000. That didn't even make the list this year. At Union Denver, the penthouse is renting for $31,199 a month. That is staggering. At the Pullman, $18,115 a month. So if anyone has some interest in renting a very, very nice penthouse, there's 2 of them available at this very moment. All you have to have is $31,000 and or $18,000. $18,000 is a bargain. Let's not kid ourselves. So what's the overall impact of COVID-19 in 2020? I would have to say overall it's very, very minimal. On the rental market, it's not been without its challenges. It's not been without regulatory headwinds. It's not been without eviction moratoriums at the federal, state, and local level. But the overall impact when we look start to finish, it was pretty minimal. So what does 2021 look like? Cities have always competed for businesses. And we have watched that here, especially in Denver. What headquarters can we get to move here? What financial incentives can we get to bring? What tax incentives can we get to bring corporations here? In this new economy, cities are now competing for people. When people can live anywhere they want because they work a job that does not require them being in the office, they work from home, you are no longer tied to where you thought you had to be. And so many people are now looking at themselves and saying, where in the world do I want to live? And so cities are beginning to compete. I heard 2 of our mayors in an economic forum last week talk about how the shift obviously is still continuing to focus on getting good companies relocated, relocating their headquarters, relocating regional offices to Denver. But now the competition is officially on in terms of competing for people. Why do people want to come to Denver? We have lots of reasons why people want to come to Denver. We used to call super cities Boston, New York, LA, Chicago. Now there's this new list of super cities where people want to go live, and they're names we've never seen before. Denver's on the list. We've never been a super city. We've been a great city for a long time, but we've never been on the Chicago, New York list. The last list I saw, Boise, Nashville, and yes, Traverse City, Michigan, known as a super city. I never thought I would see Traverse City, Michigan. It's beautiful. It's right on Lake Michigan. My neighbors actually lived in Traverse City, Michigan for 30 years. It's beautiful. It's now a super city. People are now talking about the lifestyle in Traverse City, and when you have a job that you can work remotely, you can go live where you want to live. And renters love that kind of flexibility. So let's land this airplane. 2020 certainly was an amazing year, up and down the Front Range. We expect 2021 to be very similar. As I stood here last year and I mentioned to everyone, 2020 looks really, really good. And although there's this wild card, there is this novel coronavirus in some city called Wuhan, China, and it's beginning to make its way to the US, and we have no idea, and it's a wild card. None of us could have predicted what that wild card was going to look like. Well, that wild card is still with us. And so we're still dealing with that. We're still navigating through that. But up and down the Front Range, jobs are coming back. People are employed. People are choosing to live here even if their job isn't here because they can work remotely. Rental demand is high. Vacancy rates are low. That does one thing. It sends rental prices up. Are there still potential regulatory, legislative headwinds? Of course there are. There are every year. And last year we saw some new ones like we had never seen before. Here's a telling tale though. Wall Street can put their money anywhere they want to put their money. Invitation Homes and Rockpoint Group, that collectively, Invitation Homes went out, and this was in the Wall Street Journal last October. Invitation Homes went out, issued shares, raised another $500 million. Rockpoint Group threw in another $500 million, and collectively they established a $1 billion fund to do one thing: go buy more single-family rentals. Invitation Homes already has 80,000 underneath their umbrella, and they said, we're going to raise $1 billion, and we're going to go buy some more single-family rentals because we are optimistic that's going to be the place where where we're going to see great returns on their money. Single-family homes in the suburbs are doing well all across America, and particularly well up and down the range. And to that, I would say, happy investing in 2021. We have an amazing slate of speakers still to come. Thank you very much for your time. Have a great day.
Okay, thank you so much, Greg Batchelor, Appreciate that. I don't think I'll be renting some of those places anytime soon, but it's nice to know that they're out there, right? From the rental market now to the real estate market, our next guest is Chris McGatt. He joined Coldwell Banker Colorado in 2000 and since that time has led the company to more than 1,200 top sales agents serving 14 locations across the Front Range. This dedicated sales team helps local clients like you buy and sell more than 10,000 homes every year. We're very proud of that. This consistent success has earned Coldwell Banker Realty the top spot in Colorado real estate for the last 10 years. Chris is proud to be a longtime Coloradan. We are thrilled to have him join us tonight as he talks about Colorado's robust real estate market. Please welcome Chris McGatt.
Elaine, thank you very, very much. It's great to be here today. Greg, thank you for the insightful information on the rental market. What a robust and exciting market that is. And this is rather strange not seeing a large group of people here. We have 6 people all socially distanced. You all look great with your masks on, but I do feel like it's a bit of like an audition. I hope I get invited back tomorrow. Listen, we're talking about a really exciting topic and a topic that is always top of mind, but this year, even more so than years past, the housing market is the talk of the country, and it's amazing. As we look back April, May of last year, we were wondering if we were going to be shutting down the real estate market, and yet it is proven to be quite a year, and we'll talk more about that in a second. We talk a lot about the national market, the regional market, and also the local markets. We've got an expert in the house tonight. I'm going to let Elliot talk all about the national market. He is so well versed on that. But you know, averages and medians are always very entertaining, I think. I always love discovering what is it that a typical person spends every year, like on Christmas, the average $849 a year in the holiday season. I also just read that they're expecting that people will be spending about $142 on their loved ones for the Valentine's Day holiday. I better get going on that. But as interesting as averages and medians are, when you think about real estate, it's a little bit different. I equate it to a bit like the weather. When you look at the weather, it doesn't matter. Like, I don't dial in on the TV in the morning and discover what is the average temperature of America going to be today so I know what to wear. No, it's very local. What I care about is what's the temperature going to be in my local market. And what I care about is what's the real estate market in my local market, my neighborhood, or areas where I want to own real estate. So we get the question every year, where do we get much of our data that I'll be sharing with you? We get it from a couple of sources. Obviously, our MLSs, our multiple listing services. We've got IRIS up north, we've got RE Colorado here in the metro area, and we have PPAR down south. These are great sources for data. But we also pull data from a source called the FHFA.gov. And this is a source you can access yourself without any password, without any username, really good, solid information. I recommend you take that information down so you can access this at your leisure. And by the way, as you heard from Lane earlier, today's deck will be available for everyone. You can go back and take a look at these because it's hard to keep track of all of this, and it's super hard when you're at home on your screen. Wow. Like I said, we were wondering how this year was going to pan out in April and May, and the third quarter of 2020 ended up being one of the very best quarters of real estate history, going all the way back in time. And looking at our region, like the mountain region specifically, the numbers get even more impressive. With home prices going up nearly 12.5% year over year, absolutely astounding. New England also had a great turn-in as we did. Now, Colorado is a special place. You heard that from Greg earlier, and there's no doubt that is not changing. In fact, our home price, our valuation went up 7.4% year over year, and that topped last year at 5.4%. So certainly a very robust, a very healthy market. But this, I think, graph tells it all. It puts Colorado in the context of all the different states in the country. Colorado ranked number 27 in home value appreciation at that 7.4% last year. Now you may say, yeah, but what about those really cool states that are way at the top, the Arizonas, the Idahos? Those markets, as you can see on the graph on the screen, 12, 13, 14% appreciation. And I gotta tell you, we wanna be right where we are. Where we land in that 7, 8%, that's sustainable. We don't have those huge spikes and then falls. But I think the real story exists when you look at the history. You see, the FHFA.gov, this government agency, has gone back and been tracking homes since 1991, 30 years now. And if you looked at that 30-year window, looked at Colorado, where we sit, there's no other state in the country that has seen home value appreciation like we have in Colorado, 414%. That means if you bought a house way back in 1991 for $100,000, that home would be selling now for $414,000. No other state has that kind of success record. You know what? It isn't just about the quality of space to be able to buy and sell real estate, but it has to do with quality of life in general. I don't care if you're Money Magazine, USA Today, or Fortune, everyone's saying Colorado, and the communities inside of Colorado are an amazing place to call home. So let's take a quick look at the regional market and the local markets here in Colorado. We'll look in the rearview mirror, we'll look back at 2020 and see what actually happened. It's pretty remarkable when you think about it. You look at the number of homes that were sold in the metro area last year, a record high, going back as far as we can count, 63,000 homes sold last year, an incredible number, 7.5% over the year before. That's an all-time high for Colorado. And then you look at the actual closed listings and you look at where those price points, where was all of that activity? Well, no big surprise here. You can see from the graph here that that largest grouping of sales, first of all, happened in the single family space. 71% of all home sales last year in the Front Range of Colorado came from single family. But then if you look at that price point from 400 to 500,000, that sweet spot, if you will, that actually made up over 25% of all sales last year. Very active market. Now, listings, you can't have sales unless you have inventory. Inventory comes in the way of listings. And we actually had a decrease last year of 1% in listings. We just didn't quite have enough inventory to meet the amount of demand that we had in the market last year. If you look at where that sweet spot, that range occurred, you can see there that 46% of all new listings in 2020 all came in that $300,000 to $500,000 price point. That's where the most activity was, no surprise. The graph that you see above, the table that you see above, where you see the lighter color, those are the actual condos, and then down below it are the single family homes. That distribution matters. Wow, it was a fierce, hot market this past year, unbeknownst to anybody's predictions. We're finding right now that homes on the market, the day they hit the market until they're under contract, the median is 6 days on the market. Now, if we went back a year ago, that was 13. So this is obviously a super fueled market. We're seeing many of our buyers are facing immense competition when it comes to finding the home of their dreams. It's a very frustrating time, but it's also a really opportunistic time as well. Now, you'll see on the higher end price spectrum, when we get over $1 million, we get over $2 million, well, that number is 6, that's 6 days, that changes dramatically to well over a month. 40, 45, 50 days, those homes are on the market. So if you're purchasing in that higher price point, you've got more selection and you have more time to make that important decision. Well, all of this tightening of inventory is resulting in pressure on pricing. So whether you look at median price or you look at the average price, here along the Front Range of Colorado, it's been explosive. If you look at this graph going back to 2016, the actual median price of a home was $350,000. And now, fast forward 2020, came out at $450,000. The average sales price of a home along the Front Range of Colorado went up 8% last year from last year, topping that $500,000 price point at $525,000. This is a great little infographic, if you will. And again, it's available on the deck that's made available to you at the website. So make sure you download this. It's just a great snapshot of what's happening in the Colorado real estate market. Everything from the number of homes that are sold, all the way to the under contracts, the distribution between condominiums and townhomes, the days on market before they go under contract, and our standing inventory, all in one place. Well, the headlines are no surprise to anybody that's joining us tonight. The number of new listings that hit the market, it just didn't keep up with the demand that we had. Obviously, no surprise there, but this strong demand kept prices high, with median and average close prices reaching those all-time highs that we talked about. Listen, half the homes that sold in 2020 were priced at over $450,000. Absolutely incredible. So looking at the Front Range markets, let's kind of go north a little bit. Take a quick look at Larimer County, a quick look at Weld County. There's some really positive activity in those markets as well. Now, obviously, average sales price in both of those counties went up dramatically. In Larimer County, that number was over 10%. In Weld County, over 7%. Home sale units, the actual number of properties that have sold, obviously up 11% in Larimer County and up 4.3% in Weld County. A lot of activity. Now remember, Northern Colorado relies heavily on new home construction. There's been a lot of building going on in that market, and that inventory has supplied the market as we really needed to see it go. Very quick on market times, also in Northern Colorado. Now, shifting gears, going all the way down south to El Paso County. Really interesting inventory, obviously down dramatically, down by 23%. They just don't have enough properties down there to be able to serve the people that are looking for homes. Well, that has given incredible pressure on the price, up 12% year over year, and the actual number of units sold up 6%. They're just flat running out of inventory in that part of the state right now. This is probably one of my favorite slides. It gives us the opportunity to really look at where does Colorado land inside of the rest of the country. Again, we use the data given to us by the FHFA.gov. We look at the MSAs, those 248 markets all across the country, and we look at what was the hottest, most robust market. That was Boise, Idaho. Imagine that, with an increase of valuation at 16% last year. And then bracketed on the bottom end at 4.9%, almost 5% down, decrease, San Francisco, San Mateo, coming in at 248, obviously because how much higher can those prices get in that part of the country? So then inside of that bracket is Colorado. Starting out with Pueblo, with an explosive 8% growth in average sales price and evaluations. Colorado Springs at nearly 7%. The Denver, Aurora, Lakewood MSA at nearly 5%. Greeley just topping 4%. Fort Collins over 3%. And Boulder at 6.2%. So overall, Colorado's real estate market obviously very healthy. Coming up, you're going to learn a bit about interest rates, a bit about the highest price sale in Colorado, and then some of our forecasts and predictions coming up just around the corner. But in the meantime, Lane, back to you.
Okay, thank you, Chris. Appreciate it. Got such a small studio audience, but I'm glad you guys are watching where you are. This is the 2021 Colorado Economic Summit. We are glad you are joining us tonight, and we're going to continue talking about our real estate market. Our next presenter is Tammy Miller, and if you've ever met her, you know that she is absolutely crazy about Colorado. She's a Denver native. Tammy started her real estate career in 1997 and joined Coldwell Banker Realty in 2001. As a branch manager for Coldwell Banker for 16 years, Tammy led one of the top producing offices in the country for Coldwell Banker. Now, as regional vice president, she oversees 14 offices here along the Front Range and is committed to serving more than 1,200 real estate professionals and their clients. When she's not shaping the real estate industry, she enjoys spending time outdoors, gardening, and time with her family. Please welcome Miss Tammy Miller.
Thank you so much, Lane. And this is so different, but thank you so much for joining us today. You know, much has changed in our life in 2020. Our lifestyle, the way we live in our homes, and with those changes, we saw a shift in the reasons that buyers chose to buy and sellers chose to sell. So check this out. According to the National Association of Realtors, buyers who purchased after March were 15% more likely to buy a multi-generational home than buyers who purchased before April. Buyers who purchased after March expect to live in their homes a shorter amount of time, just 10 years, compared to buyers who bought pre-pandemic. And during the pandemic, the suburbs became more popular. 57% of home buyers chose to buy in the suburbs compared to just 50% pre-pandemic. Things shifted for sellers as well. Before the pandemic, the number one reason that sellers chose to sell was they wanted to be closer to friends and family. During COVID, that reason changed, and yes, you guessed it, it was because their home was too small. Home offices became a necessity, homeschooling became a necessity, and lots of family time, I'm sure, drove one of these reasons to sell. So sellers who also sold in March or right at the start of COVID felt a little bit more urgency than sellers that chose to sell earlier in the year. And interesting, sellers who decided to sell during COVID demanded more technology in marketing their listings. At Coldwell Banker, we stepped up. We started doing virtual showings, virtual tours, and yes, when needed, we also did virtual open houses. So although that the needs of buyers and sellers changed, we do know one thing that really drove the market in 2020 was the interest rates. Let's take a look at a little bit of history. In January of 2019, we started the year at 4.5%. Still amazing interest rates, right? In January of 2020, we started out the year at 3.75%. Just last month, we started 2021 at 2.75%. Some people would call that free money, right? So there's a couple of reasons why interest rates matter. First of all, you're definitely going to achieve a lower monthly payment. You're also going to save on interest expenses. But in our market, well, in any market, what drives more buyers is they get more buying power. So if you look at the example, based on today's rates versus the rates in 2019, a buyer could buy a $500,000 home in 2019. That same buyer today could afford to buy a home at $620,000 with the same payment with less interest rate. That gave that buyer a purchasing power of $121,000. So speaking of purchasing power, let's take a look at the luxury market. Okay, so here is some serious purchasing power. The number one home purchased in the country in 2020 was in Los Angeles at $165 million to Mr. Jeff from Amazon. Clearly he needed a bigger home, but I don't believe he received the Prime member discount for that purchase. Number two is also in LA at $125 million. Central Park South penthouse in Manhattan sold at $100 million. Meadow Lane in the Hamptons, New York, $100 million. And not to be left out, Palm Beach, Florida, with a sales price of $71.8 million. Locally, the highest price sold in the metro area was here in Cherry Hills Village. 16,513 square feet, lots of home offices there, 5 bedrooms, 5.5 baths, listed for $9.5 million, sold quickly in the $1 million market at 45 days and just under the list price. Oh, check out those taxes. We'll call that $60,000 a year. The highest priced sold home in Colorado was in beautiful Vail, 15,000 square feet, 11 bedrooms, lots of opportunity to socially distance, and 16 baths. Sales price of $57.2 million. This also ranked number 10 as the highest sold home in America. Oh, well, why not? Taxes at $92,760. Now here's what we know. It's fun to look at the luxury market and it's fun to see what homes have sold across the country. But real estate is a local phenomenon. And we know what's important is your city and your neighborhood. At Coldwell Banker, we have two wonderful tools that we use to bring that information to you. One is a market report, which will tell you what's happening in your specific neighborhood, and the other is an area report that will tell you what is happening in your city. If you haven't received a marketing or an area report from your Coldwell Banker agent, please reach out to them. There's no cost to these. And by chance, if you don't have a Coldwell Banker agent that invited you here this evening, then just email me at tammy.miller@coloradohomes.com, and I'll be happy to set you up on one of those reports. This is a sample of what those reports reflect. They'll give you an average sales price, a median price in your city or in your neighborhood, as well as active listings. All right, so let's take a look ahead at 2021. Here's a couple of predictions that we're seeing, or what we hope to see. And I wish it was a different story than last year, but much of it will be the same. Quality inventory will remain in short supply. Now, standing inventory will remain in short supply. Homes will be coming on the market, but moving off quickly. Home prices will continue to increase. We've seen it year after year, and we don't expect anything different in 2021. Mortgage rates will remain historically low. I don't know that they'll get much lower, but they will still remain low. And here's something interesting with working from home. We expect to see that the flexibility regarding location will be key, so no longer will buyers be looking to buy a home close to work, because now we can work from anywhere. Real estate strategies for 2021. Here's what I'd like to share with you. If you are buying, be prepared, get pre-qualified, select a real estate agent that knows the neighborhood that you're looking at. Pre-plan with your agent, and what I mean by that is have a strategy of how you are going to compete in the market. Unfortunately, you probably will be competing, so you want to make some early decisions as to what that looks like and how much risk you're willing to take in a competing market. Waiting is never a good strategy, and unfortunately, because you may be competing, you will need to make decisions quickly. If you're selling, even though the market is strong for sellers, pricing matters, staging matters. Staging probably matters even more than it did last year, because people need to actually see themselves living in that house. Outdoor space will be important. So really think about how you're living in your house, and if you could make some updates or some changes, if you're going to put your house on the market, you might want to think about doing that. Moving up, time's not your friend, and I will tell you in the market, whether you're moving up or moving down, time is not your friend. Identify a neighborhood that you'd like to live in, and let your agent do some groundwork for you before you set out. Thank you so much, Lane. Back to you.
Yeah, it's safe to say I don't think we heard much about the Zoom room before 2021. Some of the things that we learned this past year have definitely changed real estate. Let's zoom in now to the Mile High City, shall we? And take a look at what's happening in downtown Denver. And our next guest tonight is Emily Brett. She is the Senior Economic Development Manager for the Downtown Denver Partnership. Emily is responsible for coordinating activities within the partnership's research department, including the collection, management, and analysis of data concerning downtown Denver. She also serves as a lead author of the partnership's major reports, such as the State of Downtown Denver, Downtown Denver's Commuter Survey, and other timely reports. She knows a lot about what's going on in downtown. She also is the primary point of contact for external requests for information about downtown Denver. Emily grew up in Boulder, and we are thrilled to have her here with us today. Please welcome Emily Brett.
Thank you, and it's great to be with all of you, logging in from home in our very small group here on site. And today I'm going to talk about downtown Denver. So I want us to kind of take a little bit of a journey back in time and think about what downtown Denver was and the emotions that we have about our times in downtown Denver pre-COVID. So, what we think about is people walking on the 16th Street Mall, taking their lunch break, walking with coworkers. We think about people riding their bikes, bringing their families over the weekend. We think about, wow, this is a lot of people. So we think about Rocky's opening day. We think about crowded bars. We think about big conventions in the convention center. We think about parades and celebrations. This is St. Patrick's Day. We think about the Broncos parade. We think about our big celebratory moments as a community throughout the year and throughout the decades. We think about smaller events. We think about special fun activities on the plaza in front of Union Station. And really what this all has in common is people. So when we think of downtown Denver, what it really serves, what all downtowns do, is bring people together. It's a place for people to come together and do business, to have fun, to drink, to eat, to meet new faces, to sell new products. So what happens to downtown Denver when you remove the people because there is a pandemic? So this is what happens. So this is a chart that shows you three different categories, the three different categories of users of downtown. From the bottom up, we have the pinkish line, which is residents. We have the teal line, which is employees. And we have that purple, dark blue color, which is visitors. And a visitor is really anyone that is not a resident or an employee. And what you see here, this chart goes all the way back to 2017, and this is average daily users of the downtown core. And what you see is, pretty consistent over 2017 to 2019. You see that average daily visitor number, hovering around 250,000. You see some spikes on some really kind of fun days that, probably had some parade or celebration going on. And then you see the cliff in March of 2020 that we all remember, that kind of March 14th, 15th weekend, that everything came to a halt. Then in March and April, visitors and employees disappear pretty much overnight. We have now only 50,000 people every day in downtown. And then you can see a little bit of recovery through the first of this year. So you see that the purple line, visitors do come back, especially in the summer and early fall into downtown, but the employees really don't. The employees have not come back in large numbers, and they continue to work from home, because of the businesses that are located in downtown. One thing before I go to the next slide I like to point out is if you think about that March-April time frame, even into May, June, and think about the fact that in these three user groups, the residents really kind of get buried by all these other people in downtown. But all of a sudden, during the pandemic, the residents were the users of downtown and were, some of the only users of downtown. So if you spent time downtown, I live, right next to downtown, so I'm there all the time. It all of a sudden felt like a real kind of just neighborhood. And it's not because there were more people, it was just because those were the only users of downtown. So thinking about how this is going to play out over the next couple years. So this is the same data you just saw on the previous slide, but this is monthly data, and it only goes back to 2019. So this chart, everything that's white background is actual numbers that has already happened for average daily users by month. And again, you see that 250,000 number in 2019, down to 50,000 during key core pandemic months, and then kind of slowly climbing up to even a couple of months there in that kind of fall time period of 100,000 users. Now, we spent some time over the last month talking to a lot of our downtown businesses, our Visit Denver colleagues who run all of our convention and business activity, and tried to put together some sort of forecast of how we expect the next 2 years to unfold in terms of that average daily user, of how many people are in downtown every day. And some of the key, metrics that we are using to come up with this forecast are, certainly everything right now is driven by the public health crisis that we're in. So a lot of this is based on vaccine timelines from our public health authorities and from some other kind of COVID forecasting websites. So we do expect that in June, a lot of offices will begin to return. In September, begin to open in September. The vast majority of employees will be back in the office, with the exception of, the 10% or so of companies who will kind of stay remote. And even if the employees are technically back in the office, they're likely only there 3.5 to 4.5 days a week versus 5 pre-pandemic. Then we do expect, even in April, there's some kind of limited meeting, very small convention activity happening. And then that will increase, leisure travel increase over the summer. And then in the fall, we expect more convention and business travel. Then in 2022, we expect continued residential and job growth to kind of offset the fact that business travel is still quite a bit lower than pre-pandemic. It will take till 2024 is the projection for the travel industry to fully recover. So you'll see we're getting kind of closer to that 250,000 in 2022. So let's break down these three categories, visitors, employees, and residents, a little bit and talk about what the experience is right now and what the trends have been. So visitors, the downtown Denver hotel market really struggled last year. No surprise to anyone. But it was one of the highest performing, or if not the highest performing market in the state in terms of hotel occupancy at 80% last year, which is incredibly high, or 80% in 2019. And that dropped 41 percentage points to 38% for 2020. And then RevPAR, which is the revenue per available room, key statistic for the hospitality industry, declined over $100 per room. So you see the trend here in the graph on the top that in April was kind of the worst month at 10% occupancy. Again, we saw that kind of strong summer, fall time period, and then drop back down to kind of the high 20s at the end of the year. So another key aspect of this pandemic has been its impact on restaurant dining. Now, this is for the whole city and county of Denver. This is not just downtown Denver, but with downtown Denver being such a, having such a concentration of restaurants, this tells us a lot about what's happening in downtown. However, we do know that the average downtown restaurant is struggling a bit more than the average restaurant that's not located in downtown, just because the visitors, the employees are not there in the ways that they used to be. So what you see here is that Denver has really outperformed the U.S. in pretty much every month in terms of restaurant dining, except for in our kind of latest COVID surge in late November and December. And this is really interesting to look at in relation to our peer cities. So this is a list of 15 peer cities that we always, for the last 5 years or so, have compared ourselves to. And what we see here is Denver is in that kind of bold pink line, is that Denver was outperforming in terms of return to restaurants. Our peer cities are the US average and even sometimes the global average in June, July, August, September, October, and then November and December, hit, and because of the COVID surge in this area, we did kind of fall backwards. But you see January coming super strong. And if you look at kind of this list of cities, you see what you would imagine, right? The warm weather cities that can do more outdoor dining comfortably, they're doing well. But Denver, a cold weather city, is up there in that kind of warm weather cohort where the rest of our cold weather peers are down below. So, this is really heartening and hopeful information that shows the resilient kind of Denver consumer and how we really want to go out to our bars and restaurants. And I think we all see that when we're out and about in the city now, and it's like, you never would have imagined it's 42 degrees and people are out and enjoying themselves. So, we really expect this to be a strong winter for return to restaurant dining. So everyone keep going out to eat when it's safe and feels good for you. So now employees. So just real quick, this is a graph that shows how people are spending their time, where they're spending their time, and how that has changed during the pandemic. You see the blue line at the top is people spending time at home. So that at the peak of the pandemic was up 24%. Then kind of in that August timeframe went down to 9%, and now we're back up to 15%. So we do see that people are spending more time at home than they were in the summer, but not nearly as much time as they were in the spring. But if they're spending more time at home, they're spending less time other places. They're spending less time at retail, at work, at transit stations. So for downtown Denver, we really think of that weekday office worker when we think of returning to work, because that's a lot of our employment is that weekday office worker that can work from home and is still working from home. And that's what this chart shows. Is the gray is the visits to workplaces, and you see it really hasn't picked up at all since June 1st. So, we expect to, start to see this pick up hopefully in a couple months when vaccination rates increase and more offices are comfortable reopening. So unemployment rates, actually this was just released today, the December unemployment information for Denver. And what we see is that after kind of months of stagnation or falling unemployment rates for Denver and Colorado, in December, we went up quite significantly. We do expect this to turn around really quickly because, this is just function of the fact that we had quite significant restrictions and a really substantial COVID surge here in Colorado and Denver that has, thankfully, due to all our hard work, resolved itself. So we can't really talk about employment downtown without talking a little bit about commuting. And that's something that the Downtown Denver Partnership is really focused on, is how does that downtown worker get to their downtown office? And so we've been monitoring this kind of real-time traffic information for the Denver metro region. And this graph shows the dotted lines are previous years and the red line is the current year. And you see there really is not much of a rush hour surge yet. So this is something that we'll be keeping an eye on as offices reopen. We want to make sure that that red line doesn't get above those dotted lines as people come back to work, but might not be comfortable using transit. So that gets us to biking to work. And I'm sure some of you had this experience that you tried to purchase a bike in the spring and you couldn't find one anywhere. It was like there was no toilet paper and then there was no bikes. So and you see that data playing out on these charts. So these two charts show leisure trips by bike and commute trips by bike. The red line is 2019 and the blue line is 2020. As you see at the top, there were just way more bike trips taken in Denver this year in 2020 versus 2019. But I really like to look at this kind of blob of extra leisure trips that happened in the spring and summer and see if that will kind of translate into more commute trips by bike when offices reopen. Hopefully offices will reopen when the weather is still nice, and we're doing a lot of work at the Downtown Denver Partnership to help people use their newfound bikes and confidence on a bike to commute to work. And then residents. So, residents, in my opinion, is certainly the most important. I know I probably don't have to convince anyone here today of that, but if we hold on to our labor force, our in-migration, we can get out of this crisis, and we might be a little bruised or worse for the wear, but we will emerge stronger than other places who have not held on to our labor force. So we're going to start really small, just looking at the downtown Denver multifamily market. This is Q4 2020 versus Q4 2019. And we see, rent dropped a little bit, but not a ton. Vacancy actually went down, although vacancy is very hard to measure in downtown since there are buildings delivering every few few months, and it takes time to lease up those buildings. But total occupied units is the stat that I have been laser focused on. And what we see is that there are 638 more occupied units of apartment housing in downtown now than there were a year ago. So those are all new residents, new households that are choosing to live in downtown Denver. So we are not seeing that exodus from downtown that I think some people might have thought we would. And absorption still positive. Yeah, it's a little bit less, but it's still positive. And there's still a lot of new construction that's really attractive to renters. So then let's zoom out. This is the metro market, and this CBRE data just came out today as well. So this was really good timing. So there were two good data sets that came out today. But this shows the top 24 largest markets, and this again is just multifamily, so just apartments. And what you see here, I like to focus on where you see this pink line, which is the net absorption for the full year. And you see that we're number 4, the 4th largest in terms of net absorption, almost 8,000 new apartments absorbed in 2020, just under Houston, Atlanta, and Dallas. But, when you see that kind of New York and LA and Chicago kind of down at the bottom of the list. And then labor force. So labor force, is again the key to everything, in my opinion. And this is the reason why Denver has done so well over the last decade, is because of that highly educated workforce, in-demand workforce that is choosing Denver as their home. And now in a universe where you can choose where you live even more than you could pre-COVID, we do see indications that people are still choosing Denver. The data on this is definitely harder to measure in real time. These official kind of census population estimates are not going to come out. They'll come out in a few months for the metro areas, but it'll only be through July of 2020. So that's not going to be helpful at all. So we're going to have to wait for over a year to get those official estimates, which isn't going to work. So we look at other metrics that tell us, are people moving here? Are they still choosing Denver? And this is one of the best ones, because this is an official Bureau of Labor Statistics labor force that comes out every month with the rest of the unemployment data. And labor force, you'll see, has in the top 30 largest labor force markets, there's only 7 that have non-negative labor force growth this year, and Denver is one of them. We have added the second most, we have added the second highest percentage to our labor force. You see there, we've added about 25,000 people right under Nashville. So this is really important. I mentioned that our unemployment rate did tick up at the end of the year to 8.5%, which is higher than a lot of the other cities on this. But I would much rather be in a position where we have a slightly higher unemployment rate, but we're keeping our labor force. That means we're keeping people looking, you're either, if you're in the labor force, you're employed or you're unemployed. I'd much rather people, be still in the labor force, meaning, still looking for work, still attached to a job, and also still moving here, so have a little bit higher unemployment rate than some of these other cities that their unemployment rates may be kind of seeming a little bit lower, but that's just because people are leaving the labor force. And then finally, another key kind of high frequency indicator that people are still moving here is the LinkedIn monthly workforce report. So LinkedIn takes everyone that has changed their location in their profile and sees where they changed it, to. And Denver has been in the top 5 every month since January 2020. And the latest data, January 2021, we're number 4 again. So this is something that we really want to keep seeing. And you see at the bottom the top 5 cities over the last 12 months that are sending population to Denver. And we see also that the hiring rate in Denver over the last few months has been, the last couple months at least, has been much better than it was kind of over the summer. So we'll keep watching this. And all of this kind of wonky data at the end is just to say people are still moving here. They're still choosing Denver as their home. And they're still choosing downtown and urban places as their home, even in the pandemic. And these people will be the next people to walk and ride their bike on the 16th Street Mall, to get drunk at a bar on Rocky's opening day, to attend a conference, and go crazy in St. Patrick's Day parades. Enjoy these wonderful amenities that we have built as a city. So thank you, and have a wonderful evening.
Thanks for reminding us that we will see sights like that again before too long. We miss it. Now to a man who's known for his bow ties and for making us all laugh, right? Elliot Eisenberg is an internationally acclaimed economist and public speaker specializing in, this is my favorite part, making economics fun, right? And relevant as well as educational. Dr. Eisenberg earned a BA in economics with first-class honors from McGill University in Montreal, as well as a master and PhD in public administration from Syracuse University. Eisenberg is the chief economist for Graphs and Laughs, LLC. It is a Miami-based company that serves a variety of clients across the United States. He writes a syndicated column and authors a daily 70-word commentary on the economy. And if you are not signed up for it, I would say you should be. You can sign up at econ70.com. Please help me welcome Elliot Eisenberg.
Wow. Good afternoon. It's a pleasure to be here, and as everybody else has said, this is just a very strange experience. I'm delighted that you're here watching us live streaming on your laptop or whatever it is, or huge screen television or something. There's so much to talk about, it's just ridiculous. So let's just get to it. And let's go back to basics like we always do. What's happening in the economy? Let's break the economy down by its component parts and see which ones are important and which ones aren't important. And the single most important one is C, household consumption at 69% of GDP. How it goes is going to determine the health of our economy right now. And it's been pretty good. We got some nice stimulus back in March, $2.2 trillion. That money kept coming out through April, May, June, and July in different ways and different guises, and then it stops, and our economy keeps going through August, September, October, and then in November and December, it starts to go down. But then we got more stimulus. So C is going to hold up. It fell, but it's going to come back up again. Great news. Good. Nice. Next term is I, corporate investments in plant and equipment, 15% of GDP. We'll talk about it more. Firms are investing in stuff. They're not investing in places. They're not going to build a new factory because no one knows what the new reality looks like. But they know they have to pivot their business like crazy and start offering virtual this and virtual that and touchless entry. And how do you go to the bathroom? You use a foot to do it, or an app, or you open your hotel room with your phone or something. I mean, everything's got to be different. Shower curtains and in restaurants, PVC piping, whatever, right? Then there's G, government spending, critically important. What's going on with G is we need G to deficit spend so that we can get money to people in the form of stimulus checks, or stimmies is the new word they use apparently. It's somewhat an abomination, but we'll go with it. It sounds cool, right? Stimmies. So the government's giving money out to households, to families, to businesses, to unemployed, people looking for work, whatever, people who can't pay their rent, all kinds of stuff. That's G. So we need deficit spending. We're going to talk about how much we need. We may be overdoing it here, but that's a separate conversation. Last but not least, there's exports. Exports minus imports in brackets. When I was here a year ago, we were nervous about Corona starting. Maybe it's going to be bad. We're not really sure. It's a wild card, whatever. But I remember being very exercised about exports minus imports. We had a trade war with China. Exports were doing poorly. Manufacturing was in a recession. GDP was going to be clipped by a quarter point, maybe even 0.4 of a point. Oh my God, I mean, GDP fell by 33.4% in Q2. I mean, exports minus imports are literally right now elevator music. They'll become important again, but they're not there now. Let's not worry too much. We'll talk about them very briefly. So let's begin. The economy's made tremendous strides. There's no question about it. I mean, the economy it's unbelievable. If you compare where we were on December 31st and where we were on December 31st, 2019, and December 31st, 2020, GDP fell by 2.5%. If you look at all of 19 versus all of 20, it fell by 4. These are really good numbers. I mean, back in end of June, end of Q2, GDP had fallen by literally 10 percentage points. I mean, this was unbelievable. The fact that we could recover 3/4 of that gap, essentially, really remarkable because of massive fiscal stimulus, very easy monetary policy, and adaptation. Adaptation by households, adaptation by governments, and adaptation by business. We've learned to live with coronavirus, for better or for worse. And you can see automobile sales, they're fine. They've totally come back. You see this massive collapse here. You know, in March, April, the automakers weren't even making cars. We weren't walking out of our house. What was it? People coming to Denver. There was no one here except people living in Denver, right? So, and it's come right back. The reason it hasn't totally come back is because the fleets aren't buying cars. Avis, Hertz, and all those places that deal with business travel. There is travel going on the vacation side. So airlines like Frontier and Spirit and Allegiant are doing relatively well compared to the legacy carriers like Delta, American, and United. So that goes to the convention attendance, and people aren't coming to the convention, but they are coming from out of town. They're driving here from Kansas City or wherever they're doing, right? So autos are doing pretty well. This is overall spending, retail sales. There's an interesting story here. We're going to unpack this. First, we're doing great, and then we totally collapse. Okay, bad. But then we go, woo, way better. Remember, we got those stimmy checks. Households got $1,200 if you were a human being and you were alive, $500 if you had a kid and you were under 18. I mean, households with a couple of kids and a couple of parents are getting $3,000, $3,500. That's going to help spending, no question. So spending takes off like a rocket, and it actually goes way up above where it was and way above trend. Because if you look at this line, and you follow it through, it ends up where it is now, but it comes down. That's the economy running out of gas in November and December. That stimulus from March, the $2.2 trillion, the PPP money, and all this other stuff, helping households and small business and some big businesses too, runs out. Weather goes bad, government closures take place, restaurants close down, surging cases of coronavirus because of super spreader events in November, Thanksgiving, and it's December, and Christmas and New Year's. The fear is we'll have a super spreader event this Sunday afternoon when we're watching Mahomes and face Brady in the Super Bowl. So be careful about that. But you see this, it's still, year over year, this number is still above where it was. So sales are really good, but they're weakening because the economy peaked out literally in October. And this data you showed all your data, all your metrics, restaurant attendance, people coming to the Denver downtown, be it people who live here, people who visit or tourists, peaked out in late October. I'm going to show the same data here. And our economy runs out of gas for all these reasons that we've discussed. So there's big improvement, but sagging, and you can see it. So this is total dollars spent, you know, the numbers here, billions and so on. This is month over month. So you can see March are terrible. April, we're totally locked down and things go to hell in a handbasket. But then in May, we open up, we get excited, really good. June's really good. Then it starts to slow down July, August, September, June, July, August, and October, November, December, negative numbers. We're running out of gas. We really need that fiscal stimulus that came in the middle of December that Trump signed in the lame duck session of Congress. I would have liked to have seen that money come a month or two earlier. And I remember saying, you got to get that money out. We need the money. We didn't know these numbers until a month or two later, obviously, but you could feel it just getting a little weaker. So now we have that money. That will keep us going for another couple of months, great. But notice, the thing is, this data here, retail sales, and the car sales data, are data that make our economy look better than it is. And that's because we're now spending more on goods. How often do you go out to dinner now with your friends, to a pizza parlor? Ever? No. When was the last time you went to an Avalanche game? Ever? No. So we don't go to bars. We don't buy beer in a bar. We don't go to ballet, basketball, or baseball. It's like, so we have all this savings. And what are we doing? Oh, let's buy a Peloton. So you buy a Peloton, I buy a Peloton. Oh, let's buy a pergola for the backyard. Let's get a grill for $2,000. We're buying tons of stuff because we aren't doing anything and going anywhere. So if you look at the sale of stuff, it looks it's biased. It looks much better than it is. You've got to look at the whole thing. The whole thing is our economy is down by 2.5%. Not bad given where we were, but don't just look at the sale of stuff because that's making things look really good. Why aren't things better? Because of coronavirus. This is at core basically a healthcare problem that's become an economic problem. As soon as the healthcare problem goes away, largely the recession, and not the recession, we're out of the recession in April, but this whole thing largely goes away. We've made rapid recovery because we've learned to deal with it, and now we're getting vaccines and so on and so forth. This is a healthcare, it's not a normal recession. In a normal recession, people continue going to restaurants, they don't buy cars. Now, by contrast, we don't go to restaurants and we're buying a car because now we live in suburbia or exurbia or whatever it is. So suddenly it's totally, I have a house, I have a backyard, great, I'll buy a pool. So a guy comes with a thing and he sprays cement. I watched this happen once. They spray the cement on, it's crazy. But sure, I can't go to the Y, I may die, so I better stay home and build a pool. Because I'm saving all this money every month by not going out to eat with my friends. I mean, this is totally cockeyed, but totally true. Anyways, vaccine here is still pretty high. The caseloads are still pretty high. You can see they peak out here. They had first case wave, second wave, third wave. Hopefully the waves are over. The blue lines are the number of tests we're doing, 2 million, plenty of those. The red is number of positive cases, still too high. As this goes away, people feel better. But we're still nervous about it, right? That's the problem. We're getting better. And then this begs the question, when does it go away? So you brought up this idea of by the end of 22, we're largely recovered. We're at 200,000 as opposed to a 250,000, I think was the number you showed, right? This is based on the notion of herd immunity. When do we feel comfortable going to a baseball game and hanging out with our 47,000 close friends and licking the bathroom floor? This is the question we're struggling with, right? And we're not going to get there until we have herd immunity, that's for sure. When do we get herd immunity? It's hard to tell, but there's really good news here. First, a lot of Americans have already gotten infected. Probably 75 or 80 million of us have already gotten the illness. 25 have tested positive, literally, but we know that a bunch more never get any symptoms. They don't bother testing, or they're too tired, they can't be bothered, they don't care, whatever. And now we're starting to get vaccinated as well. There are 2 vaccines on the market right now. There's the Pfizer BioNTech one and the Moderna. We also know that J&J is coming out with one very soon that has some pros and cons, but a good vaccine. We also know that Novavax is coming out with one, and we know that AstraZeneca and joint with Oxford are coming out with one. There'll be 5 vaccines. The Sputnik 5 from Russia came out. It's also an excellent vaccine. The Chinese one, we have no idea how good it is. They've never released the data. The more vaccines that come out, the better it is, the faster we're going to get it out, because we don't need to get 1 billion vaccines from one company. We get 100 million from each of them. This is critically important. The expectation is at the rate we're vaccinating people, somewhere in Q3 we're going to get vaccines. I think now it's the end of Q3 we get herd immunity as opposed to early Q3 because we've kind of fumbled the rollout of the vaccination process. But we're getting there. This is good news. By the end of this year, we should be okay. There are 2 caveats here. 2. One, we don't flub up on the vaccine rollout. Now, we should get better as we do this more and more. This is a repetitive process. You do learn by doing here. Even government does. So we should be okay. The bigger problem here is these new strains, these new viral situations that have come out that are much more serious, right? The South African variety, the British variety, the Brazilian variety, and so on. These mutations. We're entering a period now where it's vaccinations versus mutations. We have to get people vaccinated quickly. Here's why. The more people who get infected with the virus, the higher the probability of a bad mutation. There are 6 or 7 billion people on the planet Earth. That's a lot of people to get sick. The virus essentially is buying lottery tickets. And the virus hopes to infect as many people as possible. And by infecting people, it mutates. And every once in a while, you get a mutation that, as far as the virus is concerned, is fabulous. They've had already hundreds of thousands of mutations. They're all meaningless, but 3 have mattered. The more people who get infected, the higher the probability of a bad mutation. So we're in this literal race to vaccinate before mutations get worse and more mutations come. I don't mean to alarm you. This is not my intention. But we don't know what the future holds. That's the point. But the expectation is, and these these vaccines that we're getting have good numbers. None of them are perfect against all of them. They're all worse against some of them. But all the data is really very favorable here. So we're lucky this is happening. It's happening pretty quick on the vaccine side. But there's still some threats out there. Don't be misguided, right? And because of this fear and because of this concern, household sentiment just isn't all that hot. Because we're nervous. We don't know. Should we take a vaccine? Should we not? Are the caseloads going up? Are they going down? Are there spreader events or not? Will the government come through with money or not? Will I keep my job or not? Is my employer going to hire me or rehire me, keep me in, fire me? I don't know. So because of this, it's this nervous time. Now, given all these problems that I've talked about with the vaccinations and the consumer confidence, the economy's done spectacularly well. We're only down 2.5% year over year. This is remarkably good. It's better than almost any other country. We'll show some data on that too. But we also know that we were running out of gas. This is a theme that I'm going to come back to here that explains the last quarter of the year. October was the best. November, December. And you can see it here. This is airline travel. Where do we peak out? I mean, there's holidays here, obviously here. But prior, we were up around here. And then we have more holidays, and then we go straight down. So this is weakening. This is public transit use. Emily's looking at this carefully because she pays attention. And you can see it peaked out when? Kind of end of September, early, middle October, somewhere it peaks out. That's when our economy was strongest. Next, this is people going to restaurants. Different cities, sorry, Denver's not here, but you covered it already. I knew that in advance, no point, You can see here, when's it best? Shockingly, middle October. This was the best. It's weakened. It's not surprising consumer confidence has gone down. That was the best we got, right? How about this one? Working from work. So when you go to work, you have to have an access key to get in. This is a company that provides those systems, or one of the biggest ones that does it. Castle Systems. It peaked out in end of October. Caseloads were lower. We were feeling good. All those good things. The money was still there, but then we ran out of money. Caseloads go up. We get scared. Weather gets bad. Closures happen. Workers get fired. Things deteriorate. You put it all together, all of household consumption, everything we buy, not just pants, but also services. This includes the basketball game and the baseball game and drinking with your buddies and all that kind of stuff. It looks pretty good, but then what happens to it? Well, as I've explained before, we run out of gas. Our economy was slowing. That's why we needed the stimulus. We got the stimulus. We're going to get through this crummy period of December. The money came end of December. So Jan, Feb, March, and by then, things should begin to improve. We're going to have a lot of good news. We're going to get jabs in our shoulders. We're going to get money that President Trump signed. We're going to get more money now that President Biden's going to sign. The weather's going to get better. Restaurants are going to open. Closures are going to get reduced. I mean, you're going to have a good 21. There's no question. It's almost impossible unless we get some rotten mutation. That's almost the only fly in the ointment here. It's a serious potential fly, but a low probability event. And you can see spending growth here. Same thing like the prior slide I showed you with retail sales. It does terrible in March, even worse in April, May, June, July, August, September, October, November, December. Last 2 months, declining. So you've got across the board weakening, but not all sectors are doing badly. Again, we're buying lots of stuff. And to make stuff, you have to manufacture stuff. So anything to do with manufacturing and transportation is ripping the cover off the ball. This is manufacturing. They're doing great because we want to buy stuff because we're not buying services. So we're saving $500 a week, $1,000 a month, $300 a week, $2,000 a month, whatever it is we spend on socially visiting friends, seeing each other, flying for vacation. We're doing none of that right now. So instead of buying things, manufacture. Truckers, they're thrilled out of their minds because we got to move this stuff from the factory to a warehouse. The warehousers, they're totally happy too. They're full of stuff. Service guys, restaurants, not so happy. This is this complete inversion of our economy from the normal recessionary behavior. I used to talk about and say, recessions don't affect healthcare. Why? Because you can't predict, you can't elect when you choose to get cancer. You get cancer, you go to see a doctor. Not now, because you may get coronavirus when you go see the doctor to get your cancer checkup. So suddenly things that we believed could never change, that would never change, have completely changed. So our economy is really, at a small level, quite different than it was. Manufacturers are thrilled. Look at this number, capacity utilization. Remember I showed you the other slides, November and December, running out of gas? Not here, because they're making stuff. These guys are working nonstop, and they're having trouble. They can't get enough supplies because manufacturing bottlenecks in other parts of the country or other parts of the world are preventing them from getting what they need. That said, utilization rates are going way up, and when they hit somewhere about here, certainly 77.5% now, that's when you begin to build plant and equipment. Now, we're not there, but we'll get there soon enough. The reason it's as low as it is actually is because inventories were brought way down because firms didn't know what the future was going to bring. And they said to themselves, look, I don't know what's going to be. I better not invest in things in June, July, August, September, October. Let's run inventories down and turn inventories into cash. But now they got to build inventories again, so this is going to help. So utilization rates are higher. How about capital goods orders? Oh my God, this is crazy. Here we are in the midst of this horrible thing. Our economy is completely on its back in the end of June. We've fallen at a seasonally annualized rate of 33.4%, and yet firms start to buy things like crazy, just straight up. Because firms realize if they don't adapt, and they don't manage, and they don't pivot hard, quickly, and smartly, they're gonna get crushed. And they figure, what do? We gotta buy software, new hardware, new this, new that, whatever it is that your business needs, your client's business needs, that you need. As a realtor, you've had to rearrange your business. As a closing agent, they've had to, the title companies have had to, everybody's had to, Guardian, they've had to change their MO, or right? Everybody's had to do something. And and it costs money to do it, but firms know it's either spend the money now or go under, essentially. So they're spending the money. Great, this is helping the economy. Oil prices have actually gone up, and West Texas Intermediate crude's now in the low 50s, down from, up from negative 40 for like an hour back in April, a really bad day. But things are improving, so in Weld County, you might see a pump jack, maybe 2, not 6, but 2, maybe, I'm making it up, but you get the idea. This is gonna help the economy. And firms are happier too. Firms are feeling much better. They've bought this hardware they needed to survive. Some of them are investing in plant and equipment. They're building cell phone towers, storage facilities, cold storage facilities, self-storage facilities, logistics, anything involving no people. That's doing really well. But when it comes to office space, hotels, retail, not quite so much. But there's some stuff, but firms know what to expect now. They have a better idea of what's coming down the road. And they can say, look, in the past we were shrinking our dividend payments a lot. Now, no one's doing it now. They either did it and they're done, or they're reinstituting them now because they feel confident about what coronavirus means for their industry after having been living through it now for 10 months already. So this is a good thing too. The stock market's doing crazy well. I'm marginally a little nervous about that, but I'm not a financial analyst guy, so I don't dwell on that. But part of the reason the stock market's up is because interest rates are super low, firms are recovering, and the expectation is things will get better, and bonds pay 0. So there's a fear of, there's TINA, there is no alternative, and FOMO. I should have bought GameStop last week and sold it 4 days ago. I could have retired. I missed that, but I'll catch the next one. So I'm on Reddit nonstop looking at whatever crazy kitty or whatever the handle of that guy from Boston is, and I'm figuring out, I'm kidding, stay away. Socially distance from GameStop. That's my recommendation. But the stock market's doing well. Easy monetary policies help drive rates down. Fiscal policies help giving us these stimmy checks. Oh, well, let's buy something. But I'm not kidding, but this is helping our economy. We feel better, we're more likely to spend some money, which we need to have happen. But as I've said before, we were running out of gas. You can see it right here. This is per capita disposable income. So what happens is the recession starts, Congress is very kind to us and sends us lots of money for a couple of months. We get the one-time $1,200 checks to $600 checks and so on, and then it ends. The unemployed get $600 a week. PPP money comes out that's almost all forgivable to many corporations. That helps spending as well, but it runs out too. And you can see the numbers down, 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 down. Stevie Nicks talks about that, by the way, in one of her great songs, but Fleetwood Mac. But you get my point. Now it starts to go back up again because Congress is giving us more money again. So we're going to reverse this process of straight decline. You can see in the next slide, too. This is savings rates. This is very interesting. There's a lot to unpack on this one. So our traditional savings rates are what, 7%, whatever they've been, here around 7% for the last 10 years, since the global financial crisis of 8-9. What happens? We get the stimulus money. Woo! Wow, 34% savings. Most people ended up saving the money, at least initially. They certainly didn't spend it on fun stuff. They spent it on rent. They spent it on paying down credit cards, paying down bills in a lot of cases. They didn't know when their job would come back, lots of uncertainty, and many people saved the money. Now, over time, the savings got eaten away. So savings rates are still double what they were before the recession began. This is worth something like $1.2 trillion. There's a ton of savings out there, not being held by low-income people. They've spent the money in low-income households. But middle-income and higher-income people have this extra money. They're saving it because they either got the stimulus checks if they qualified, and if they didn't qualify, they've been not going out to see their friends. So they're saving all this money. I was going to go to Europe on a vacation, but that would have cost $20,000. I'm not going to go now at all. So it's in savings. So when we can actually go out to a baseball game and do something fun and buy a luxury house for $74 million somewhere, that money gets spent. So this will also help 2021. We'll have more stimulus money, continued monetary policy, better weather, opening up hotel restaurants, more travel, right? And this extra money. It guarantees 21 is going to be a good year. And here's the extra money that Biden's going to give us. Biden's going to do something as well. We don't know exactly what, but we'll talk about it in detail now. So President Trump passed this one back in March. Trump signed this one into law in December in the lame duck. Now President Biden's going to do more. He wants to do a $1.9 trillion deal. The Republicans are saying $600 billion, and Biden is essentially very delicately saying, I don't think so. I think he's going to try and use reconciliation and try and push it through on a 51-50 majority vote in the Senate without any bipartisan support. Now, that could change. The Republicans would come on board. They can make a deal, whatever. Remains to be seen. But even let's suppose they make a deal and it's $600 billion. On top of the 9 that came is roughly $1.5 trillion. On top of the 2.2 that came earlier, this is 25% of GDP. I mean, this is becoming a very large amount of money here. So there's tons of stimulus. The economy's going to recover quickly here, GDP-wise. Labor markets are going to recover more slowly. But there's going to be more. This is, again, making 21 going to be a good year. There's too much fiscal and monetary and cash and weather and vaccines. And I mean, you just look at this list. It's just very large. Is it raising our deficit for 2020? It did. It rose it a lot. It increased it a lot. And it will do it again in 21. Not quite as much, but it'll still do it quite a lot. But this is important. Remember, monetary policy is at zero interest rate right now. So the Fed can't really do much. The Fed's going to tell us they can do a lot. And Powell talks about powerful, powerful, powerful. When you use powerful adjectives, it means you've got nothing in the bank, right? You know, the State Department says, you know, we deplore some behavior in some country. Oh, now it's Burma. They had a takeover in Myanmar, right? They're using very bad adjectives. That means they're not going to do anything. So when you hear Powell say, powerful, we have powerful, powerful, he wouldn't have to use those words if he really had something powerful to use. Now, he does have something still left in the arsenal, but not a lot. So the point is it hurting our deficit? Yeah. Is it hurting our debt? Yes. Is it the right thing to do? Yes, because monetary policy is kind of out of gas, and fiscal policy, interest rates are super low. If rates are 1 or 2%, I mean, you were talking about that, Tammy, or rates are low, your spending power is higher. This applies for government too. Our cost of servicing our debt has never been lower, despite that the debt to GDP ratio has never been higher. Now, rates down the road could be a problem, but in the short run, when the house is on fire, you take the water hose and you douse the flames. You don't go, oh, we have a water shortage right now. Let the house burn. That's the wrong time. You can always put low-flow toilets in when you rebuild the house, right? There's a time and a place for everything. Worrying about the deficit today, not really. As far as exports are concerned, again, it's elevator music, as I mentioned earlier. That said, the dollar's declining, so that's helpful, obviously, for manufacturers and exporters, but there's a catch. The US primarily exports services. We export tourism, people come here to visit, but they're not coming. We export movies to movie houses abroad, but they're closed. We export education. Foreigners come here to go to school, but they're not coming. What's our single biggest exporter in the US? Number one, Boeing. And for a bunch of reasons that I'm really not going to get into, they haven't been an export powerhouse of late. Maybe those C-suite guys were penny wise and pound foolish, literally. And this was a disastrous decision that cost them, $25-30 billion in penalties, foregone sales, and just bad stuff. But exports aren't going to be a source of wellspring of stuff for the near future, and it doesn't matter. If you put it together, this is what we've got. We had Q4 looking pretty good at 4% growth. But remember, Q4 was a great October, a weaker November, and a weaker December. So we walk into January on the downswing. So January is going to be a crummy month. In February, we turn it around, and hopefully in March, we begin to get better again. So Q1's not going to be a good month, whether it's 2% or 1%, we could argue, but it ain't going to be 4, that I promise you. Could it be 0? I don't think so, but I give it a very small, but not 0 probability of really a crummy 0 quarter. I don't think so. I think there's too much stimulus coming, and the vaccinations and so on make us happy. Q2, good. Q3, this graph doesn't show it, but Q3 is better than Q2, and Q4 may well be better than Q3. So we have 3 straight quarters of improving economic performance because of all the stimulus we've talked about. Usually rates go up as the economy improves. But we're going to get to that later, but rates aren't going to be going up. So rates are going to be staying low despite the improving economy because the Fed's going to keep them low deliberately. So 21, we're going to get, 5% growth in 21? At least 4.5. We're going to create 4 million, 5 million jobs. We'll still be 5 million jobs, 6 million jobs short of where we were. But this is going to be a very good year, so enjoy it. And this is what the future looks like in terms of 20 and all of 21. You can see here, 4.5% ballpark. I don't know exactly, but at least 4, maybe 5. If you go to bed early, pray, clean life, you get 5. Good news. And to compare the US to other countries, how have we been doing? This is the IMF OECD data. They measure different. They measure 19 versus 20, not year-end 19 versus year-end 20. So they're showing the negative 4% performance, not the negative 2.5. It's the same thing, just measured differently. You can see the US has done relatively well, right? We haven't done spectacularly, but we're beating the average, which is, we're above average. This is like Lake Wobegon or something. And you can compare to other big European and industrialized democracies, we're doing pretty well. On one hand, we've done worse on combating the virus. So our death rates per million or 100,000 are higher. But we've been much better on the fiscal policy side and other ways of alleviating the problems that this disaster has led to, right? So we've been much better at mitigating the problem and not so good at attacking the problem head on. Okay, I'm not going to get into that, but this is nothing to be horribly unhappy about here. And this is the change from October to now. This is IMF data, and you can see here the US expectations have improved. Euro area, they've gotten worse. China, they've gotten worse. Japan better, Latin America better, and the world overall better. And the US is now pretty much up with the world, whereas in October we looked much weaker than the world. Because of the stimulus and the vaccine, relatively quick rollout, the US is one of the best big industrialized countries. I mean, there's Israel and the UAE and Seychelles are rocking it, but they're much smaller. But the Brits are ahead of us. They're the only country ahead of us that's a Western democracy. So we're getting the rollout pretty fast. That's in part why this is going to look pretty good down the road. Let's talk about labor markets. They matter to us here. Labor markets are getting better, but they're not going to get better as fast as GDP. GDP will recover to where it was prior to the start of the pandemic, somewhere in end of Q2, early Q3. It'll happen before we reach herd immunity, which is probably going to happen in the end of Q3. Somewhere 2 or 3 months earlier, I think, with the stimulus coming from President Biden, we get there a little earlier than we otherwise would be the case. That's pretty good. Labor markets aren't going to be so lucky. As I mentioned before, we may create 5 million jobs in this year. We'll still be 5 million jobs short. It may take us 2 more years, a year and a half beyond that. So we're somewhere in like 24 or late 23 before we get all our jobs back. And that's because my employer, for example, Chris, he had to let people go. He had to let you, Tammy, go. He had to let me, and I had to get you, Mr. Batchelor, let go. And then he realized he could hire only 2 people. So he figures he'll hire you because you're smart. He'll hire you because you're a good speaker. And then Elliot, there's no place for him. So he doesn't hire me back. Worse, he doesn't even miss that I'm gone. He misses my rugged good looks. Yeah, I know. I'm serious. But he reorganizes how the office works. More technology, more hardware, more software, better training. You jump into the breach. And that goes on in hundreds of thousands of factories and retailers and wholesalers and stores across the country. They wholesale change how they operate, and suddenly they don't need quite the workers they did because of new technology and stuff. So people lose it. That's why it's going to take 2 extra years for the labor market to recover compared to the overall GDP number, real GDP. So here we were, we lost 22 million jobs. We come back and get back 12 million. So we're down by 10 million. And then what happens in December? In December, remember, we're running out of gas. So the total job numbers decline just slightly. They go backwards by 140,000. Not a lot, but down. Now let's look at the month-to-month changes in this graph. So in May, 2.5 million, 3 million jobs. In June, 4.5 million jobs. That's 1 month. We had lost 22 million the prior 2 months. We got back 4.5 in 1 month and almost 4 the prior month. And then it's 1.8 in a million and 600,000, 400,000, 200, and the negative 140,000. The economy was running out of gas. Fiscal stimulus comes now, and the new stimmies, things begin to turn around. January, we may show, if we're lucky, I'm guessing 0 job growth, better than negative 140, but we're not going to get 300,000 or 400,000. It's just not going to happen, right? Unemployment rate declines quite precipitously. This is really good. It was really high. It comes way down. It's not quite as good as it looks. First, the unemployment rate was actually a peak of 19.7. The Bureau of Labor Statistics admitted they made a mistake. They put it on their press releases. They weren't hiding it, but they miscoded entries. They miscoded because they didn't think the pandemic mattered. So they coded things the way they do in a normal situation, despite the fact that like 12 million people were now in this situation. So they just missed it. They also missed it last month in December. I don't know why, but they did. Anyways, the peak was actually was 19.3 or 19.7. And last month, it really jumped up from 6.7 to about 7.3. So 7.3 is still not bad. It's way better than it was. But even that shows us looking better than it is. And you go, why? Because of this. The labor force participation rate dropped out. You talked about that at the end of your talk, about people, you want people to be looking for a job and attached to the labor force, attached to working, even if they don't have a job. What this is showing is people lost their job and they said, adios, I'm walking out. I'm going to be sofa surfing for the rest of my time. I'm going to be taking some indica. I'm going to be in the couch. This is Colorado. You can say that stuff around here. I live in Miami. It's illegal. We don't talk about drugs. No one even does drugs in Miami. Miami Beach, there are no drugs in Miami Beach. None. I've looked. I've seen. There's nothing. The point is, you see this precipitous decline in the labor force participation rate. People have simply dropped out. So if you take the real unemployment rate of 7.2, and you add to that this effect, you're in the upper 8s, mid 8s. So this is, remember, it was 10 here. Now it's mid 8s. We've made improvement. We were at 19.7 or something. So we made huge improvement, but we're not done yet. Why is it that GDP can improve so quickly by July? Yet the labor market's going to take 2 more friggin' years to improve. What the hell? Why the dichotomy? Think about it. This economy's clobbered lower income people. Lower income people, by definition, earn less money. They're in less productive industries, earning lower incomes. So if you lose a swath of this low income population, in terms of GDP, it's not a lot of money. But because productivity is low, there's a lot of employment in there. So you're not seeing the loss in GDP. That's why GDP improves so fast. But that's why the labor market's going to take so long to improve, because these are lower skilled, lower educated people whose productivity is much lower, right? More than that, the labor market still is laboring under real difficulties. This graph shows us first-time unemployment claims. So you were employed last week, like I was, and then Chris gives me the pink slip, and now I'm unemployed. I go to the unemployment office and say, that schmo, make sure to give me unemployment, make sure to charge it to his account, right? Now, that's not how it works in a realty firm, I understand that, but you get my point. Prior to the recession, 200,000 jobs a week were lost. So 200,000 people a week were going collectively to unemployment offices in the country saying, I'm unemployed, give me unemployment money. The highest all-time number in this series prior to the onset of this pandemic was 695,000, somewhere in 82. The double dip, the second dip of the double dip recession of Ronald Reagan in his first term. It hit 7 million at its worst. So 10 times worse than the all-time bad number. Okay, it goes down, right, good. But then it kind of levels off here at 900,000. 900,000? This is any of these weeks. Pick any single week on this entire graph in isolation. Pick any one you want, and it would be an all-time high in the history of the series, going back to the mid-60s, with the exception of the last 40 weeks, since middle of March. And this is now, we're now 10 months, this is 40 weeks, 42 weeks into this thing. We still have 800,000, 900,000 people a week losing their jobs. There's tons of churn. Restaurants open, but they close. Delta hires people and lets them off. Disneyland opens and then closes. Firms don't know what to do. They're pivoting, they're buying technology to help them survive, but some guys like gymnasiums, they're just having a really hard time. But getting back to this K-shaped recovery, people on top kept their jobs, they haven't lost, they're working from home, they're buying fancy homes, things are pretty good. But at the bottom of the pay scale, the person entry-level job, person hasn't finished college, maybe not even high school, selling a pair of pants at the Gap, they're in the bottom. Look at their unemployment rates. If you have a college degree, you're in yellow or gold, whatever color you're looking at the bottom, your unemployment rate has continued to decline, and at its worst was 8%. Now that's not great, don't get me wrong, but it's a far cry from what it was here for those without even a high school diploma. And look what's happening now. If you're the least educated, your unemployment rate's now trickling back up again. And if you have a high school diploma in red, or even more than high school in green, it's flat. Who's buying a home? The people in yellow. This is a recession, unlike the last recession that completely clobbered housing, and housing may have been at the forefront of creating it. We can argue that point. This time, housing has benefited wildly. It isn't even collateral damage. It's like collateral beneficiary. It's sort of an unusual, just the opposite of what we thought back in March, April, May, when we thought we were all going to have to just change careers and panhandle for a living or something, right? Or become buskers or something, right? And play the guitar or something at a subway station or something. Now, in terms of inflation, I'm not convinced we're going to get it. There's a big debate in the economics profession about inflation. I'm on the side that I just simply don't see it. I could be well wrong. I'm putting it out there. This is not one of those cases where I really have deep convictions like I do about 2021. This is one where there's room for argument and we could have a give and take. This is total compensation. Total compensation is the single biggest factor firms pay. If there's no wage increases going on, there ain't going to be any inflation. Now, will there be down the road? Maybe. Do we see it so far? This data came out 2 days ago. If you don't see wage inflation going on, it's hard to see overall. Now, could we get inflation because oil prices spike or there's not enough toilet paper around? Sure. But that's not going to lead to a perpetual increase year over year in inflation. A one-time bump up in the cost of something, a year later, that inflationary pressure totally goes away. You need to see inflation perpetually go on. Every year you see 4% inflation in toilet paper. That's a whole new thing. That's not going to happen. We're all of a sudden not going to decide to utilize more toilet paper as a society. We have, however, decided to use better quality toilet paper. I'm digressing here, I know. But it's so interesting, I can't help but share it with you. When we worked in the office gave us crappy sandpaper, essentially. But now that we're at home and we control what we purchase, we're upgrading. We're not buying recycled toilet paper, not literally recycled, but you know what I mean, from recycled fibers. We're now using virgin pulp. It's more expensive, and firms have had to rejigger their assembly lines, manufacturing different qualities, and that's actually led to inflation in toilet paper. But it's a one-time increase in inflation. We're not going to keep buying fancier paper every year. So you've got to think about what's a permanent one-time boost and a perpetual, like wage inflation is perpetual. Every year I want 4%. That's a very different story than the toilet paper scenario. Now, let's look at inflation in detail. This is the CPI, what you think of as inflation. Do you see any inflation? I mean, it could come. There's evidence out there. Producer prices are going up. Margins are being squeezed. If firms have power, the ability to push their price increases onto consumers, they'll do it. But right now, they don't have the power. Their margins are being squeezed generally. This could change. You know, all of a sudden things get better. We have our $1.5 trillion in our pocket that we're spending. We have the injections. We're feeling good. We're going to games. And suddenly the cost of a hot dog at Coors Field is now $37, not the bargain 26 it was before, or whatever it is, right? But heretofore, no inflation. The Fed doesn't even, red is core inflation, excluding food and energy. Food and energy go up because food goes up and down because of weather, and energy prices go up and down because of war. And so you ignore this. These are one-time effects. It just happens once. There's a drought in Saskatchewan or too much rain in Australia or something. So corn crops go bonkers or wheat or something like that. That's a one-time effect. 1 year it goes up and then it's gone. That's not going to cause systematic inflation. The Fed uses this measure of inflation, PCE inflation. Do you see inflation here? No. Could it come? Yeah. But I don't think so. I don't think so because our population's not growing very much. Last year, 2020, was the worst population growth in at least since 1900. 2019 was the worst since 1918 when we had the Spanish influenza that killed 800,000 Americans. 2020 was worse. They don't have data any further back. With no population growth, you just don't get inflation very much. You cannot get inflation in the long term. It just can't happen, right? We're also aging as a result. Old people don't take risk. Young people bet the farm, try new things, they invest, they put their house in hock to borrow $100,000 to follow their dream and open up a business, or like Bezos in his garage, or whatever. Not old people. No. There's no inflation in the world. You don't see a lot of inflation in Europe or Japan, or some, but not a lot. So I just don't see it happening. This is trimmed inflation. So look at all the goods of inflation, from the thing that goes down the most to the thing that goes up the most. Knock off a bunch of those, and look at the broad middle. You see inflation here? No. But then people say, well, Elliot, I think you're missing the most important thing. How about the money supply? The stock of money. It's going way up. This got to cause inflation. I mean, didn't Milton Friedman say inflation is everywhere and always a monetary phenomenon? This is plenty of monetary phenomena. Not so fast. Because of this. Look at the velocity of money. Completely crashed. So the point is, let's say I'm the government and I give you $1. I give you $1, you $1, you all get $1. And you all take this $1 and you bury it in the ground. That's why the monetary velocity is gone. Those dollars, they're not circulating. You need that money to go. You need that money to be borrowed by a borrower, and you need a bank to lend it. And for a whole bunch of reasons, that's not happening. Could this start? Yeah, it could. The Fed can also raise rates to stop it. So just because inflation starts to go up doesn't mean the Fed goes, oh my, look. They're an active participant in here. They have the power of agency here. They're not going to let inflation get out of control. Now, they do want it to go up. They want it, I'm going to go back a couple slides. They want it to be at least 2%, so red, core, PCE. But they want it higher than 2%. They want it higher because it's been too low. It's been below 2% here, not there, here, not there, here. So they say they want 2%, but they can't deliver it. So the Fed's going to say, let's pump it up to say 2.25 or 2.5. Let's run the economy hot and heavy. Let's see wage gains go up a little bit. Let's see inflation take off. Then we can raise rates and slow the economy down. Remember, they raised rates in 2018. The housing market in 2018 wasn't bad, but it wasn't a great market, right? Because rates were going up. They raised rates just 1 percentage point and 4 25 basis point increase in increments over the year, and that was enough to weaken the housing market. They can do it again. If they think it's getting out of control, they'll just raise rates. But they're not going to do it anytime soon. all right? Now, does Wall Street see inflation coming? Yeah. Wall Street always sees inflation coming. For the last 40 years, Wall Street's seen inflation coming. Have we had any inflation? I'll show you soon the interest rates on a 30-year mortgage for 40 years, and all it's done is go like that. So, did they saw inflation here? Did it come? No. How about here? No. How about there? No. How about here? You know what the answer is. Now, could it come here? Yes, sure it could come. But I'm not convinced. The jury's still out, but what I can tell you is rates aren't going up anytime soon. There's just no way. Because the Fed said they want to see inflation above 2%, 2.25%, 2.5%, 2.3%. They haven't told us what that magical number is when they start to get hot under the collar, but it's going to happen at some point. They've also said they want to see inflation expectations. So what we think inflation will be down the road, this is measured every month and by a couple different places, so we know what this number is. They want to see inflation expectations be well above 2%. And the kicker, they want to see unemployment rapidly approaching its terminal level of 3.5, 4. We can argue what that number is. It was 3.5 before the recession began in February. That was the lowest number in 50 years or 60 years since Vietnam, so I guess late 60s. To get all those three things ain't going to happen tomorrow morning. Moreover, the Fed has been buying $80 billion a month in treasuries and $40 billion a month in mortgage-backed securities, MBS, Fannie and Freddie debt, right? $120 billion a month. The Fed will have to tell us they're going to start tapering. Then they're going to have to actually start reducing the purchases of treasuries and MBS. Once they've done that, then they can begin to think about raising rates. For those of you old enough to remember when Ben Bernanke, who was chairman of the Fed like 8-9 years ago, talked about getting rid of tapering the purchases of mortgage-backed and treasury securities back in 2013. He just said, this might be a good idea. What followed was something called the taper tantrum. The word tantrum is never a good thing, right? So the Fed now has to think of how do we tell markets we're going to start tapering without markets going ballistic. Interest rates jump by like 100 basis points, like in a month or two after the taper tantrum. So the Fed's got a lot of work before they start to raise rates. This is my best case scenario of Fed funds rising. Now, let's talk about housing. Oh my God, this gets fun. Housing is the best market in the whole US economy. A bunch of you have already mentioned this, right? Not only are you smart, not only are you good looking, but you're in the best sector in the whole US. Auto sales have done well, retail sales, manufacturing has done well. I could go on. Recreational vehicle sales have done well, pool sales have done well, pavers, pelotons, pools, pools, all P's. Nothing has come close as housing. Housing has rocketed, but there's a catch. The catch is not a bad catch, but there's a catch. First, overall, general overarching scenario. Notice, every single sector in construction sucks, with the exception of residential housing. So data came out yesterday on construction activity. It was good, because housing was like this, and all the other sectors were like this. When you add them together, the number's not half bad. So housing is covering up for all the crumminess of housing everywhere, not housing, for the construction activity, public construction, public and private non-res, commercial, industrial, whatever. And some of them are better than others, I mentioned before. Freezers, logistics, cell towers, and so on. They're not bad. So this is first-time mortgage applications. This is someone goes to a loan officer, maybe in Littleton, for example, I'm making it up here, and says, I want to get a house. Can you help me? So you have intentions of buying. This is not a refi for rate and term. This is wanting to buy a house. Could be a second house, but it's a house. Could be new, could be existing, we don't care. This number shows great numbers, right? It's phenomenal, it's way up. Ha-ha, but the catch. Now I open the curtain. This is the most important graph. You're going to see this graph over and over again in the rest of the presentation. Watch closely. This is 2020, the light blue, 2020 prior to the onset of the recession. So Jan, Feb, first half of March. You're doing gangbusters because the prior year is here. So you're doing meaningfully better than the prior. December 19, Jan 20, and Feb 20 were great months for home building and for sales. They were like the best in history since the global financial crisis. Then the crash comes, we're locked in our homes, and you can see first-time mortgage apps crater, right? And then they make a remarkable recovery. A V shape. The only sector of the economy that has the V shape, housing. because you're in Colorado only because the two of you are so smart. But what happens in July? It's up here. The gap between July and the prior year is this distance. That distance is what I care about. That's the improvement of 2020 post-pandemic to 2019, same month. And the gap doesn't change. The gap is flat. This distance here, 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 and there is pretty much, it bounces around from month to month, but it doesn't change. What does this mean? It means this. You start out the year in a fancy car going 60 miles an hour. You then fall to 30 miles an hour because things are in the garbage can. Then you sell your 30 mile an hour car and you buy a Ferrari and you go to 100 and that's it. You're done. You can't get better than that. The housing market from July or June or whatever the month is here, right there. So we're week 24. So we're somewhere in, I guess, late May or something, right? That's as good as it gets. It's a great market. You're 20% systematically 20% better than the year before. But it doesn't get better. There's no inventory. Prices keep going up. And you talked about interest rates being low. And on a $500,000 house, the lowering of interest rates allows you to buy 22.5% more house to $625,000, if I'm not mistaken. But prices are eating away that benefit. So the rates but they won't get lower. They're going to go up a little bit. So rates are going to go up a little. Prices are up. There's no inventories at 6 days. I mean, now, coronavirus goes away, inventories will go up because people who are reluctant to sell will now be willing to let people in their house because they're not going to die showing their house. Okay, so there are mitigating factors here. I'm not saying no, but I'm saying basically the housing market is running full damn tilt. And I'll show you other slides to show you the same thing by looking at different angles of the same story. We'll look at different dimensions of the housing market. This is first-time mortgage apps. What's selling the best? This is MBA data. Shockingly expensive homes. $766,000 or more are the houses selling best. Because you're moving from LA, you're moving here. You're moving from San Francisco, you're moving to Sacramento. You're moving from Seattle to Boise. You're moving to a cheaper city, you're taking your equity basically and buying a free house. And you have a lot of money because they're much richer on the West Coast than they are in the interior of the country. This is existing home sales, something near and dear to everybody in this room and hopefully not in this room. So the data here is exactly the same like I showed you before. So it was good. This was the best number we had except for maybe a month or two there going back to 2007. So 2019 ends on a great note, right? And then starts, Jan-Feb is the best, crash, and amazing recovery. Now, break it out year over year like we did before. Look at the top graph, ignore the bottom graph. It's interesting, but not that important for us. Now, I want to look at the gap between these lines and the blue line. It's roughly static. It's a little bigger here. That's an outlier, I think, there, and that's probably an outlier too. But generally speaking, you're not seeing a big gap or a gap systematically widening from prior year. So I think this also says the same story. Why can't it get better? Because there's no effing inventory. There's nothing to buy. Inventory by NAR is 1.1 million units. This is not seasonally adjusted. So you only can compare January to prior Januaries because you can see there's seasonality. Jan, Feb, March, April, May, June, July, August, September, October, November, December. It's up and down, up and down, up and down. That's seasonality, right? So you compare this January to last year. It's like down by 40% or something. 6 days of inventory. You can't push sales much more with 6 days. So you got inventory problems. The builders can't build enough. Prices are going up. This is a great market. Don't get me wrong. It's just you can't get any better than you are. It's like you're an A student. You get a 4.0 GPA. You're 5 beta Kappa. You get a huge fellowship to schools. Every school wants to take you for college. This is as good as it gets. You have a golden future, but it doesn't get better than that. You're the best student in the school. You're the valedictorian. So this is new permits. Starts. We'll show a very similar story here. There's a little variation on this story, but it's the same. So that's multifam starts 19 in blue. Now 2019, December was a great month, as were January and February and March. And then things begin to correct. So compare the last 6 months of the year. July, August, September, October, November of 2020 were the best months. Builders could sell anything they built. They were never been happier, and how much can they sell? Well, it's a little better, the same, a little better, a little better, a little better, a little better. And it's roughly the same size. The gap between the blue and the red doesn't really change much, because the builders, they're going full tilt also, but they can't find workers, they can't find supplies, there are bottlenecks. The guys making the check off, the inspectors, they don't want to die and get COVID, so they're not even checking the homes. I mean, I'm kidding, but you get my point. There's a lot of impediments here. So the builders can't build more. The loan officers, they can't make any more loans. They're working 24 hours a day. You guys can't sell more because there's no inventory. I mean, how many headwinds can you have? You got a lot of headwinds, and despite that, you're still running 100 miles an hour in your Ferrari. This is a great story, but don't expect it to improve. It can stay this way for a while. But I'll come back next year and eat my shorts if it's better, I will. Housing starts, so here's housing starts. Total housing starts year over year, the same thing. The blue line is essentially the distance between here and here, here and here, here and here, here and here, here, pretty much the same. There's one outlier there. I don't know what happened that month. The builders were high or something or whatever. But now single fam, however, is doing systematically really well. This gap is not as big as this gap. So single fam builders are building a lot. The multifam, for obvious reasons. Who wants to live in a multifam situation? I'll live in a 27-story tower with all my neighbors pushing the button and giving me COVID. In the short run, in the long run, they'll come back, but not in the short run, right? This is new home sales. Something, again, near and dear to your hearts. What do you think this graph's going to look like? You already know what the graph looks like. I've already shown it to you 3 or 4 times. Yeah, right. This is new home sales. They take off like a rocket, they stay high, and then they sink. What's going on here? What's going on is a new home is considered sold when the contract is signed. So you're my builder, Tammy. I come to town, I want to get out of where I live. I hate where I live. I live in friggin' downtown worthless Denver. Everyone's killing me there. I want to move to suburbia. I want to move to Golden or something. Can you build me a big house on a hill? You say, sure, give me $100,000 down payment. Here's $100,000. And then you say, well, Elliot, I'm kind of busy right now, but I'll start your house in 8 months. That kills sales. Promising to start the house 8 months. Now, these people were desperate to get the house. They didn't care. They said yes. But after a while, the buyers go, I'm going to wait. Maybe things will get better. Now, it's still above where it was, but you see this problem. It's the same story. You're going 60 miles an hour. You're going 30 miles an hour, you're going 100 miles an hour. I've showed you in new, existing, starts, permits, first-time mortgage apps, it doesn't matter. Are the builders happy? They're out of their minds happy. They can sell whatever they want. And despite the fact that they've never been happier, they aren't even coming close to building as much homes as they built 12, 13 years ago when they built 2.1 million seasonally adjusted for a few months, right back in 05, 06, somewhere there. We can go back and look, but it's actually, let's look, let's just see. Here, there. That was the peak. And they're here. I mean, this is ridiculously low, given how happy they are. They should be building more, but they're not. And how about new inventory? There's nothing there either. Inventory there went from here almost 600,000 to 275, 300,000. It's half. So existing inventory, not seasonally adjusted, is down by almost 3/4. Existing inventory is down by roughly half. There's nothing to buy anywhere. This is new inventory. Now, month's supply of inventory is going up now. So the builders are saying, well, that's why this graph here might be explaining why they're also not willing to build more homes. The buyers are reluctant, and the inventory is starting to float up a little bit here. It's back to some normal level of 5-6 months, but you see that you just can't get beyond where you are. There's too many impediments. It's a great market, and this is the crux of the problem. Builders didn't build any homes for 10 years. The builders never got the memo. They were fishing, they were becoming crop dusters, working for the post office, opening a pizzeria, working on their handicap. I'm not belittling them. That's not my point. They couldn't make any money. There was no demand. Because of that, they didn't build, and a whole generation of people didn't learn how to lay brick, put on shingles, do plumbing, electrical work, and now there's no one to do the work. And that's why they're stuck at 1.6 million. On top of that, regulatory costs drive the cost of home building up substantially. It's a real problem. And believe it or not, even though we're in the midst of getting out of a recession, when we're 10 million jobs short of where we were, there's no extra supply of labor for residential construction. Look at blue. The blue here is residential building, and the number now is back where it was, even higher than where it was before the recession began. And in red, residential specialty trades back where it was too. So we're 10 million jobs short, but not in residential construction. They can't find any, so I'm competing with you. You have Greg, he's a really good builder, he's good. So I hire him away. I pay him $2 an hour more. He's not loyal because you're a rotten employer. He's happy to come to me. But now I'm building more, you're building less. As a city, we're not building any more homes. So the builders can pilfer workers from each other, but until you get an increase in supply of labor into residential construction, you can't get more homes built. That's the problem. Oh, and lumber costs are way up too. So it's gonna cost an extra $25,000 or $20,000 to build a home. And I've looked into this a lot. I've spoken to a lot of lumber guys, mills and so on. They closed so many mills back in 6, 7, 8. You can't just take a mothballed mill and start it up overnight. And these guys aren't convinced that this housing boom will last. So there's a combination, and there's lots of renovation work going on, and all these restaurants are building outdoor huts using wood. So wood demand is skyrocketing, supply ain't there, and it ain't gonna recover overnight. And you can see the number's been staying up there. This ain't a joke. So you have land problems, you have labor problems, you have input problems, and you got rental work doing terrifically. This is 21 Q1, because we hate our house. You know, I may hate my husband, I can't change him. I may hate my wife, can't change her. I may hate my kids, I can't get rid of them, but I can fix my house. And that's what we're doing. So the workers that are in limited supply are now being pulled into renovation work as well. So you have to use the same pool, but it's being spread over more things, making it hard to find construction workers. And this problem isn't going to end anytime soon either, because demographically the demand for housing is going to be very strong for the next decade or so, because the youngest millennials here are aging into home buying, right there, yellow. And the oldest Gen Zers are on the verge. And the height of these bars here is really high. This is the biggest cohort we've got aging into home buying over the next 10, 12 years. Big demand. And credit is hard to get right now. Talk to a loan officer, talk to your friendly loan officer and say, and they'll say, nah, this is not 2007 when you fogged the mirror and got a loan. How much do you make? 100,000. Can you prove it? Yeah, I have some paperwork in my trunk. I trust you, it's okay. We'll give you a no doc, option only arm, you know, you're fine, you're good. Now look at this is from mortgage bankers. You can see lower is worse. We're back to the credit situation we had back in 2014. We've lost 6 years of easing credit availability in 7 or 8 months. It will get easier. Demographics will improve or continue improving. Credit will get easier to get. And look at interest rates. They ain't gonna be going up much in the near future. So rates are gonna stay low. And prices keep going up. Prices keep going up. Last recession, they crashed. This recession, woo! So why wait? As you said, Tammy, waiting isn't your friend. There's no point waiting. Get on with the show. Do whatever you're gonna do. Sell what you got, buy what you want, whatever it is. Waiting isn't we're not gonna see a price decline next year or the year after. We may see lower price appreciation, I agreed with you guys. But a price, no, this just too much fundamental demand, and there's this lack of supply. Now, what's the fly in the ointment? If I struggle, the fly in the ointment is forbearance, the forbearance programs. And I don't see it being a huge problem. The demand for homes is insatiable. The number of homes in forbearance, as you can see, is about 2.7 million. It's not like a trivial number, don't get me wrong, but demand is 6 million homes a year right now. It's not like these 2.7 million homes hit the market tomorrow. They're gonna hit the home, 100,000 a month, 50,000 a month for a while, and some more will get worked out. But on top of that, the special factor here is there's home equity in these homes. 12 years ago, there wasn't any home equity. So the lender wanted to get the house as quick as they could and dump it on the market as fast as they could, because every day the house was falling in value. Now, every day, it's going up in value. 1% a month. 1/30th of 1% every day. They're not in a rush, so they can wait to sell the house, keep the people in the house, sell the house, they kick them out, And then the borrower, the lender, gives the borrower who hasn't paid in a year a check for their capital gain, the leftover money, after they've satisfied the mortgage. This is fundamentally a very different situation than it was in 08-09. This is not a problem that's going to metastasize and be awful. As long as prices keep going, or just don't go down, we're good to go. Now, quickly, locally, a little bit, and we'll end. Again, the market's losing steam. This is October data. The darker the color, the better. Don't focus on the color of any individual state. They bounce around like basketballs. They look at 4 different measures. The key thing is the overall color palette, literally. This is October. It gets lighter in November, yes? Lighter. And how about December? Even lighter. And now color is actually technically going to decline. Again, don't pay much attention to the color of any state, but go back. Dark, lighter, lighter. The economy through Q4, October, November, December, was cooling down. So we start 21 in January, essentially in this situation. Not a great story. Now, that said, Colorado, not only are you smart, not only are you good looking, not only have you picked the best industry in the country to be in, you've picked one of the best states to be in one of the best industries in the country. So you're like lucky, like 27 times over. Colorado's growing fast. This is a year-old data. I don't have the latest data. But Colorado grew 1.2%. Well, here, 1.2% for the year ending July 1st, 2019. It's a little slower this year, but not meaningfully slower. So you're like the 7th fastest or 8th fastest state in the country growth. And by total numbers, you're 7th fastest. And you're small. I mean, 6 million people. The states above you, with the exception of Arizona, are much bigger. And California, they aren't there at all. California in 2020 lost total population for the first time since they became a state, like in 1840 or whatever the number is. You should, as realtors, thank every day, pray for the health and welfare of Governor Gavin Newsom. Not only pray for his health and welfare, I would send big PAC contributions. You want him to win re-election every 4 years forever. You want to get a constitutional amendment to California allowing the governor to stay beyond 2 terms, because he is your best advertisements. Raises taxes, PG&E can't even supply power. You have no electricity, it's hot, you're stuck in your home, the traffic's bad, taxes are going up. It's just not, it's not all Gavin's fault, I get it, but you got to make jokes. Now, over a 10-year period, where have people moved? This is clear as day. If you take a line from Washington, D.C., a straight line, which is curved because the globe is not flat, through San Francisco, that's where people move. The only exception is Idaho, a little bit of Oregon and Washington. That's it. It's the Intermountain West that's rocking Texas and the South. Why? In all those places, generally speaking, you have at least 2 of the following 3. You have good weather, low taxes, cheap housing. Some have all 3. Here you have all 3, right? Here you have 2 of the 3. Here you generally have 2 of the 3, although Utah and Nevada pretty much offer 3 of the 3. Colorado now offers 2. But up here, you have none of those 3. California has none of those 3 either. The country's moving. There's systematic demographic movement that's going to continue and go on. The South is more popular and the West is more popular because of weather, taxes, and home prices and traffic. That's not going to end. And last but not least, a couple slides locally here in Denver, and then we'll wrap it up. This is new construction activity. Your home prices are going up. I'd like to see more homes being built. You don't have enough homes. We talked about that. And this shows there's been some solution to the problem, but not enough. So here's single fam. From the axis up to the red line is single fam. Single fam hasn't gone anywhere. It's too expensive to build a house. The land, the labor, the permits, you can't build a house at $500,000, the magic number. It's not doable anymore. The million help, that you can build, but not the entry level or the near above entry level. So they stopped. You can see the number of homes being built in Denver hasn't gone up in 5 years, even though home prices have exploded. No single fam. Now there has been multifam. Multifam is the gap between red and blue. So up from 0 to red is single fam, from red to blue is multi, and the total at blue is both the single and the multi together. So you see there has been, from here, there was very little multifam being built here because the gap between blue and red was almost 0. Here you're seeing quite a bit of multifam, but not enough. They're building like crazy downtown, but they need to build more. You need to make it easier for them. Do something, talk to some politicians, just tell them there's a problem. I'm sure they can fix it very quickly. all right? This is home prices. We talked about that earlier. Prices have doubled since 12 Q1, let alone the 400% since 1990 that you showed, or 91, whenever Federal Housing Finance Agency had the data out there. And which houses are going up most expensively? Quickly, most quickly. That was bad English, expensively, I'm sorry. What do you see? Cheapest homes going up the most, because the builders don't build any. The only solution to the problem is more construction and hopefully some more supply from existing sellers just opening up their home for sale. But fundamentally, it's new homes that are going to solve the problem. But since the builders aren't building any new homes at the low level, the demand for those homes is really strong. And they're going up faster. And the days on inventory are what, like 4 days or 3 hours or 9 minutes or something? In the middle, they're going up, and the high end, inventory's 40, 50 days, you mentioned, right? So the prices are going up too, but not quite as fast. Holy cow. This has been a lot of information. So first, let's wrap up here first. First, this is my name, cell number, phone number, Twitter handle, email address. I put out 70 words every day on the economy, no graphs, no ads, no charts, no links, no photos. You were kind enough to introduce, when you introduced me, that you should sign up. To sign up, you can go to my website, Econ70, you can email me at Econ70, or better yet, text the word bow tie, one word, to the 5-digit number 22828. You'll be prompted for an email address. You'll hear from me every day till you die. You cannot unsubscribe. It's the only address you cannot. I talked to ICANN, you can't. I paid them off, you can't do it. All right, quick review. The economy had a bad Q2 last year. It recovered like a rocket. We're only down 2.5% to 4%, depending on how you calculate it. A great recovery. We're going to have vaccines in 21. We have savings in 21. We have more stimmy money in 21. We'll have better weather in spring and summer. Closures will go down. Restaurants will open up. Everything is going to come up good, with the one possible exception of a bad mutation. The rest should be a good year. We should create 4 to 5 million jobs. Interest rates are going to stay low. Home building is still going to do well, but not do better. And the entire housing industry is going to do very well in 21. But we're not going to see any improvement over the last 6 months. Yeah, a neighborhood, sure, a county, yeah, but not the overall area. You cannot, because the builders can't build more, there's not enough inventory, and so on. Have a great year. I look forward to seeing you next year very, very much, hopefully in person.
Thank you, Elliot. Always a good time. And wow, I'm energized and exhausted at the same time. So that was awesome information. And thank you to everyone who's watching our 2020 Colorado Economic Summit. What a great day, what a great event, and I'm hopeful that you got some information out of it today that you can use in your own life. We want to thank all of our presenters. You can't see them, but they are seated in front of me for being here today. We also want to thank our sponsors as well. They're back here. You can see them. Thank you to our sponsors for helping us put this event together, and also our technical staff for bringing it to you. We are live tonight, and it is exactly what we had hoped for. So thank you for your help. Wanted to let you know that if there was some information tonight that you would like to share or look back on, the slide deck will be available to you by February 9th. Checking my notes here. February 9th, you want to write this website down, coloradoeconomicsummit.com, coloradoeconomicsummit.com, or contact your Coldwell Banker Realtor for more information. Remember, when it is time to buy or sell real estate, we hope you'll consider Coldwell Banker Realty. On behalf of all of our speakers tonight, thank you so much for watching. Have a great and healthy evening, and thank you again for tuning in.